So how's it going, everyone? This is just a portfolio update for my dividend investing account in Canada. The last time I did one of these was back in, I think it was January 27th, 2020. And in this video, I showed that my account was at 339k. So today is September 26th, 2020, and I guess that's the update. We'll pull up the Questrade account here. As we can see here, same account, same everything. The market value is at 369k, close to. So on the surface, from 339 to 369 is like a 30k gain. But there's so much behind things that you need to look a little bit deeper. And I'll show you everything because we're just being transparent here. So what happened over the past 8 months? We can show the investment summary here, investment returns, and then I'll pick my account. Where is it? This one is it. We see over last year, in September to about January, everything is fine. It's just up and down 2 or 3%. And then in February, it tanks 6.4%. And this is the whole portfolio taking a dive. And then another 12.7%. So 6.4 plus 12.7, that's like 19.1. So everything dropped by close to 20% in the March bottom. Then since then, every single month has gone back up. Now on average, maybe 2.8 to 3%. Okay, so we don't really care about these dips, but there are some things that you need to do during these dips for the dividend and portfolio account activities. Now I'll show you some things I did backdated to April. We have all these actions that we have here. So that's action. Everything that happened for the past 6 months has been buy, deposit. I never sold anything during all this dip. And because that's the mentality of the dividend account. It's just a net buy. We're just treating it as a black hole and we just keep buying and then we buy a little bit more when it dips harder. So we'll see what we picked up over the past 6 months. We have Shaw Communications. That's my telecommunications play. We have Chartwell Residence. So that's the retirement homes. It took a deep dive from the illness, but I think over the long run, it should be fine. They didn't cut the dividends. Canadian Utilities, that's kind of like my Fortis, but I just want to diversify through the sector type of thing. Rogers Communications, that's another telecommunications play. VDY.TO, that's a pure dividends play. There's I think it's got like 4%. Same thing, CNQ. CNQ is something that I never thought I'd buy. So it's called Canadian Natural Resources, pretty much all the miners. So I bought it with the mentality that when the recession hits, the government kind of funds all these companies to mine more, to create more jobs. Therefore, they just kind of do better. And then CNQ again, I bought some more. Loblaws, from this illness, I think we all have gone to the supermarkets a lot more. We cooked ourselves a lot more rather than go to restaurants. CAR-UN.TO. It doesn't matter how the economy does. The REITs, like people still need to live. So these will still continue to pay out. CNR, as I mentioned in the other video, is a monopoly railway play. There's no other player that can just like randomly build a railway to compete with you. So you can charge whatever you want. VDY again, I bought some more. That's like a no-brainer. It, by definition, is just called Canadian High Dividend Yield. It's an index that gets like all the Canadian high yield companies. I'm going to show you quickly as to what it is. If we go to Vanguard and then type in VDY, remember it's Vanguard Canada. We'll show the companies that they have. So all of these like are the high yield Canadian companies. Mostly banks, and then some energy, banks again, energy, bank, telecommunications, insurance, energy. On average, I think there is like a distribution here. It has 60% financials, 26% oil and gas, telecommunications 9%. So that's like a majority, that's like 90% of the whole portfolio. And then we'll see is dividend payouts. The trailing is 4.78%. So it's pretty much a no-brainer because you can never look at every single company like in depth to see how it's doing and then how it'll do. So if you're just to buy one dividend ETF, I would just go with the VDY. Like you have some extra money and then you don't want to think about which stocks to pick, just buy this one. We'll go back to the Questrade account. We'll take out as we see here, the deposits. I think we made more than 30K of deposits for sure. So here, 5K, that's 10 already, and then 10 more, so 20, 30, 40. We started at 339 and we added 40, it's 379 already. But the account was only at 369 because there was a huge hit to the economy for the past 6 months. But that's okay. We'll go back to activities. Right now, we're just taking a look at what kind of dividends I received. DIV means dividends received, and REI means my drip program's working. So we can see here we had a dividend payout of $163, and automatically it was used to buy 7 more shares of TELUS, and then it took $154 off my account. And that's the drip program we keep talking about. Whenever things get paid out, like here as well, TD Bank, they paid me $540 and it automatically deducted $526 to buy 9 more shares of TD. We see here for something like Canadian apartment properties, it paid out $34, but it didn't reinvest it to buy more shares. Obvious reasons that this stock, Canadian CAR, is $46. So I don't have enough money to automatically buy more shares. In order for it to automatically buy more, then I have to buy more of these shares, enough so that it pays out like $50 to just automatically buy an extra share every time they pay out. A lot of my larger holdings, it did this process. So pay out and then deduct. And then here it paid out and then deducted to buy 3 more shares. So this process happened quite a few times over the past 6 months. If we just click on dividend reinvestments, so REI. So all of these were the automatic reinvestments. This kind of demonstrates a snowball effect because once you invest that principal and you let it roll, you just let time do the work. Let's say if you have 100 shares at the beginning, after 1 year, you have 105 shares, let's say. And then next year, you have 112 shares. So the gain is kind of like, it's not linear. It's exponential, but it's really slight exponential because let's say the first year you gain 5 more shares, next year 7 more, and then 10 more, and then 15 more type of thing. But then every share you gain will gain more shares itself when it reaches that capacity. That's the power of snowball effect. If you haven't looked at the video of the snowball effect, I'll put it up here. That video is like how Warren Buffett made billions. That's just to demonstrate what the theory is about. So this is what happened to the account. And then now we're gonna look at the holdings. Okay, for this account, I have a total of 17 holdings right now. And it can be chopped up to 7 different sectors. So number 1 is like an essential to me. It's telecommunications, and I own 4 different companies in this sector. So Bell Canada, and then Rogers Communications, Shaw Communications, and TELUS. All of them, they pay, I think about, on average, about like 5 to 6% yield. It's 6% right now because the stock price has dropped this year. But if it picks back up, then it'll average around 5% yield. We'll show that the dividends, they've increased the dividend payouts for the past 3 years. And I don't really see them missing a beat here because of how this illness affects us and how critical internet is now. That is a key that makes you want to keep these stocks. Another sector that I have is residential REITs. The key word here is residential, not retail. Because retail, it'll be a tough play over the coming years in my opinion. As we visit the malls nowadays, we don't see much action and everything is just happening online. Once people adopt this habit, it's really hard to turn back. There are a couple of major players. I think Microsoft, they decided to close all the retail shops. It's a permanent move. They're not gonna suddenly come back and open stores again. That's the same idea as Tesla. They're also just selling cars online. So the whole retail sector is rough in my opinion. If you have any retail stocks, consider switching it out, because even if they're paying like a 12% yield right now, their stock price is most likely going to drop more than that. So just buy something you believe in and just hold. So the two REITs I have is residential, as I remember. CAR-UN.TO, that's Canadian apartment properties. So people have to live. This one took a huge hit. Right now is minus 27% for me. My average cost per share is $13. I think the lowest it got is around like $6 or $7. So that's like almost a 50% drop. I think this whole illness thing will pass. Again, people have to live. It doesn't matter how old you are. And senior homes is just necessary in my opinion. And then another one is natural resources, as I mentioned, CNQ.TO. They have a pretty nice dividend payout as well. So right now they pay 7.7%. Is huge. What made me want to buy this? I didn't even look at what they do. Are they pure miners, or are they reselling the resources? What do they do? But a couple of things that triggered this buy is that the end of last year it peaked at $42, and when I bought it, it was like down here somewhere. It was down here like $15. As we see here, over time, this is a very cyclical industry, because I used to work for an engineering firm that did mining as well. And about every 5 years, it takes a dip, but then it comes back up, and then it comes back up. And then right now, we're assuming it's the dipping phase, and then eventually it'll pick back up. In the meanwhile, they're giving me 7% to stay, so I don't mind it. And then we'll see how their dividend performs historically. CNQ, a very steady increase in the dividend payouts. It started with $1.10, increased by 24 cents, and then 26 cents, and then 20 cents. So every year is increasing by 20 cents. I think even at these prices right now, compared to 6 months ago at like $14, it may still be a buy, because you're playing like a cyclical game here. I don't have that much in it, as we see here. The market value for my portion is only like 4.4 grand. And the percent of portfolio is like 1.1%. I think I might just add more in the month of October, because I buy new stocks every month, and this might just increase it to like 2%. So 1.19%, it doesn't even matter. It could be my smallest holding actually. So we have another 1.36% here, Shaw Communications. I just added that last month. We'll build it up. Number 4 would be utilities and necessities. So utilities, we have Fortis Gas. It doesn't matter how the economy does, people still need to live, they need heat, they need hot water, so they'll continue paying their dividends. Canadian Utilities, CU.TO. Okay, their dividend payouts is 5.51. We'll check its dividend payouts historically. Same idea, 1.43, 1.57, 1.69, 1.74. Increasing dividend payouts at 5.5% is just another way to diversify across the sector. And then for the banks, financials, I have 3 different holdings. EQB, that's an online bank. They pay like 1.7% for your savings account. Much better than like a 0.2% from the banks. And then we have Royal Bank, and then TD. So these 2 holdings, it's quite large in my portfolio. We have 12% and 11%. And I'm not going to put any more money into it. I'll just let it grow on its own. Same as Fortis, 11%. The next sector are these indexes. We have VDY, VFV, and VUN. For VDY, we already looked at what kind of companies they hold. as we saw before, Royal Bank, TD, Enbridge, banks, telecommunications. So I have some overlapping, but it doesn't matter. There's so many of these that I don't have, and I don't mind some exposure into it. Another two is VFV and VUN. So we'll look at a comparison. I don't really think there's a difference with these two, but we'll see with like actual data. So we'll compare it with VUN. Okay, we'll take out the previous ones. So this blue one, dark blue, is let's see the over past year. The dark blue is the VFV, the light blue is the VUN. So as you can see here, it's almost identical. Over past year, the differential is 0.7%. We'll compare its dividend payouts. I believe that's also really close. Dividend yield is 1.42 for VFV and is 1.3 for VUN. If we compare these two with the index of SPY, which is the S&P 500 ETF in the US, so over the past 5 years, we see sometimes this one is higher, sometimes the other one is higher. So overall, the differential is only 5%. I mean, it doesn't matter which one you buy really. One of the reasons why I buy both is just to average in between. When I buy both, instead of getting one of these 66 or 70%, I'll get 68%. And I'm okay with that to average my risk within the risk of diversification. You don't have to get both, you can just buy one. Either one's fine. Yeah, so that's the whole portfolio. And then there's CNR, as I mentioned, about the rails and how monopolized they are. So I think overall, I'm quite happy with the portfolio. Again, we're at 369. I'll continue to deposit money into it every single month and get more shares until we get to that $1 million mark. Right now, we're at 37%. So hopefully over, I don't know, the next 5 years, we'll get there. I think that's reasonable. We'll see. Let me know if you're interested in these type of videos. Everything's unscripted. We're just winging it, showing my thought process behind my portfolio. What do you think? Like, are there stocks that I should add to this mix? Comment and let me know. I mean, no one's perfect. This dividends game, I'm still learning. I'm only in it for like 5 years. But I think we have maybe 15 more years to go. I'll just regularly put money into it and let the snowball grow, right? So again, we need to be mindful of like what the purpose of the account is. For this one is pure dividends. So even if it rides out and it has these dips in between, it just means that you get to buy more shares at a discount and nothing else. Because as we know, over time, over the past like 100 years even, it's pretty much the same type of trend. There are different cycles where stocks dip and dip and dip, but then slowly it'll climb back up. Because we're in it for the long game, these little dips don't matter at all. You only change your strategy whenever they cut dividends or whenever the sectors are in deep trouble, like maybe the retail sector in my opinion. But if you stick with the staples and utilities, I think you should be fine. That's the end of this video. Let me know what you think of this format again. Remember to subscribe, like, and comment if you found any value in this video. Take care, and I'll see you in the next one.